After much anticipation, a new tax bill has passed. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. My name is Nicole DeRosa, Senior Manager at Wiss, and I am very excited to be your host for the tax episodes. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this and other episodes, stop right here, hit the pause button, and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of the NJCPA or Wiss. So let's get into it, shall we? I know it's been a while. Just a mere 4 days following the House passage, President Joe Biden signed the Inflation Reduction Act of 2022 into law on August 16th, which is projected to raise more than $700 billion in revenue through federal policy changes impacting U.S. energy, environment, and the tax sectors. This act has been dubbed IRA, not to be confused with individual retirement accounts. Several noteworthy items that are not included in the final bill are a provision to remove the SALT cap, reinstatement of the research expensing provision under Code Section 174. Reinstatement is now likely to come through either a separate bill or perhaps the year-end extender package, and also changes to the carried interest rules. Prior versions of the bill had proposed an extended 5-year holding period in order to qualify for the long-term capital gain treatment. Moving along to several of the bill's major tax implications generally effective for tax years beginning after December 31st, 2022 are, we will first start off with the creation of the 15% corporate alternative minimum tax rate. The Act imposes a 15% corporate alternative minimum tax on adjusted financial statement income of applicable corporations. By definition, an applicable corporation is any corporation other than an S-Corp, a RIC, or a REIT, to which 3-year average annual AFSI exceeds $1 billion. For these purposes, a corporation must calculate its 3-year average without regard to financial statement net operating losses, but with regard to certain specified adjustments to book income in order to determine if the average in any year exceeds $1 billion. Specified adjustments include items of related entities, foreign income, disregarded entities, federal income taxes, non-reasonable compensation, covered benefit plan amounts, and tax depreciation. Next, we move on to the creation of a 1% excise tax on corporate stock buybacks. A tax equal to 1% of the fair market value of any stock of the corporation which is repurchased by the corporation during the year will be imposed on each covered corporation. A covered corporation is any domestic corporation, the stock of which is traded on an established securities market and extends to certain affiliates of U.S. corporations, as well as specified affiliates of foreign corporations performing buybacks on behalf of their parent organization. A repurchase is defined as a redemption under the U.S. tax code or any other economically similar transaction. The 1% non-deductible excise tax does not apply to the extent that the repurchase is part of a reorganization and no gain or loss is recognized on such repurchase by the shareholder for reason of such reorganization. It also does not apply in any case of which the stock repurchase is or an amount of stock equal to the value of the stock repurchase is contributed to an employer-sponsored retirement plan, employee stock ownership plan, or similar plan. It does not apply in any case which the total value of the stock repurchased during the tax year does not exceed $1 million. It also does not apply under regulations prescribed by the IRS in cases in which the repurchase is by a dealer in the securities industry in the ordinary course of business. And last but not least, to the extent that the repurchase is treated as a dividend. Moving along now to something more familiar, the extension of the excess business loss limitation through 2028. This CARES Act provision was originally expected to sunset for years after 2025 until it was extended by 1 year from our friend ARPA to the end of 2026. The act further extends the excess business loss rules for 2 more years through taxable years beginning after December 31st, 2028. It is very important to note that any disallowed amounts do convert to a net operating loss in a subsequent year and currently carry forward indefinitely, offsetting up to 80% of taxable income. Ultimately, what we have here is a big timing difference. So continuing on with some familiar items, the extension of the premium tax credit through 2025. For individuals and families who are enrolled in an exchange purchase qualified health plan and who aren't eligible for any other qualifying coverage or affordable employer-sponsored health insurance plans providing minimum value, a refundable premium tax credit is available. This is no stranger to us tax practitioners. The Act suspends indexing of the applicable percentage table for tax years beginning in 2023 through 2025 and replaces the percentages, which will enable more people to ultimately claim the premium tax credit for those specific years. So, shifting gears now to energy, we have several extended and expanded energy-related tax credits in the Act. Without getting into too much detail here, the bottom line is that many energy tax credits were either extended, expanded, or even created with the Act. The new Clean Vehicle Credit tweaks how previously existing vehicle credits were claimed and calculated in the past, and now introduces certain limitations for qualification, with the 200,000 manufacturer limitation eliminated. This tax credit can be worth up to $7,500. Some of the new limitations for this credit include a modified adjusted gross income under $300,000 for married couples filing jointly, and $150,000 for single filers. If you make too much money, you don't get the tax credit. The cost of a van, sport utility vehicle, or pickup truck must not exceed $80,000, $55,000 for all other vehicles. Manufacturing location of the vehicle and sourcing of battery components do come into play here, as well as the minimum battery capacity. The Act also introduces a credit for previously owned clean vehicles, which allows taxpayers an income tax credit equal to the lesser of $4,000 or 30% of the vehicle sales price once every 3 years. Like the new vehicle credit, there are limitations on who can actually claim the credit. You make too much money, you don't get the credit. The cost of the vehicle must not exceed $25,000. This must be the first sale of the used vehicle, and the vehicle model must be at least 2 years old. Moving along to the home, there are many extensions and modifications of previously existing energy credits, the most noteworthy being the residential energy credit. The Act adds and expands several types of qualifying types of property and adjusts the phase down and phase out rules for claiming the credit. Previously, there was a lifetime credit limitation on various types of property, which going forward will be replaced by an allowable credit up to $1,200 per taxpayer per year for residential energy property expenditures, windows and skylights, which capped at $600, exterior doors capped at $500. A $2,000 annual limit will apply for amounts paid or incurred for specified heat pumps, water heaters, biomass stoves, and boilers. In addition to the residential energy credit, the residential energy efficiency property credit for solar, electric, solar hot water, fuel cell, and small wind energy property has been increased to 30%, up from 26%, for property placed in service after December 31st, 2021, but before January 1st, 2033. The Act also makes this credit available for battery storage technology expenditures. So, saving the best for last here, we have substantial increased IRS enforcement funding. The item of the Inflation Reduction Act that is getting the most attention and making news headlines is that it provides nearly $80 billion of new funding to the IRS, broken down into 4 major categories. We have just about $3.2 billion towards taxpayer services, which includes pre-filing assistance and education, filing and count services, and taxpayer advocacy services. We have more than $45.6 billion towards the enforcement category, which that'll be determining and collecting owed taxes, providing legal and litigation support, conducting criminal investigations, monitoring digital assets, hot tax topic, and carrying out related compliance activities and enforcing criminal statute violations. $25 million and change goes towards the operational expenses, including, rent, facility services, postage, security, and information technology development, which we all know they need severely. And almost $5 billion towards modernizing the IRS's computer system, upgrading related in-house technologies, maintaining legacy systems, and developing callback technologies. So, of all the appropriations to the IRS, Most taxpayers and practitioners alike are obviously concerned about the appropriations to the enforcement category. The IRS Commissioner Chuck Rettig said that the IRS funding would not increase audits of households making less than $400,000 per year, and that the resources are absolutely not about increasing audit scrutiny on small businesses or middle-income Americans. Obviously, only time will tell, but one thing is certainly for sure, like any employer, it's going to take substantial time and training to hire competent employees. So this is something to definitely keep an eye out for in the future, but not likely in the imminent future. To access articles and events about the Inflation Reduction Act, go ahead and visit njcpa.org/IRA. And of course, I encourage all NJCPA members who are involved in taxes to join the Federal Interest Taxation Group for free at njcpa.org/groups. Thanks for listening and watching. Have a great day, everyone.